Hello and welcome to another edition of the Goldman Guide. Thank goodness for the weekend, right? It halted at least momentarily one of the market's worst weeks in some time. I assume that you all have read a number of stories and articles about the Silicon Valley Bank government shutdown slash takeover, which happened in about 48 hours last week, towards the end of the week, of course. Instead of rehashing the background and all the details, we're going to offer unusual insights and where we go from here. We also introduced some new data that's quite relevant to last week's events. And by the way, just a quick heads up, not all bad news is bad news. But more on that in a moment. Let's see where we are today. On a year-to-date basis, which we go through in more detail a little bit later, the Dow Jones Industrial Average is down 3.7% thus far this year, while the S&P 500 and Russell 2000 are both barely above water. Meanwhile, the Nasdaq Composite, which had been roaring in 2023, is now up 6%. It's a far cry on all fronts from the highs achieved just 5 weeks ago. The VIX, which we've identified as your suggested coat for the stock market winter, is up now over 14%. And now the RSIs down here, they plain old plummeted and are singing strong sell songs, and they probably will for the foreseeable future. And these forward PEs, they'll be updated shortly, but it's clear that they've taken it on the chin too. Bitcoin, by the way, which was up 50% at one point this year, is now down sharply from its year-to-date high. But with respect to the indices, what's really scary is that after such a nice run, we are now between 8 and 11% above the 52-week lows on the key indices. That's just a hair. And I would not be surprised if we touch those sooner rather than later. Still, technically, that means we could reach oversold RSI levels soon as well. So, there is a partial silver lining here. On the notable numbers front, the AAII sentiment survey figures, we're at the bearish figure right now at 42%. Of course, last week we were at 45. I'm sure we're going to be at 50 this coming week, maybe even higher. And that will take it closer to its recent high of 61%. So that could be at least modestly positive, maybe help stave off some things. Meanwhile, the ETF fund flows experienced some really unfortunate moves. Not only were inflows the biggest in weeks, but they were in risky equity sectors and assets last week, rather than the short-term debt inflows of recent weeks. So they really got crushed fast. Now, a few random thoughts. Let's address these. They come to mind and should be addressed, frankly, after what transpired last week. So the first question that comes to mind is, how long are we going to endure a double whammy of interest rate hikes and the Silicon Valley Bank fallout, as well as the CPI issue? So if you recall last week, the market was already getting smacked around with Fed Chair Powell making comments about interest rates and how inflation's higher, and we've got to raise interest rates perhaps faster, maybe even larger increments, from a quarter point to a half. So we were already in negative territory before this all happened last week. And now, this week on the 14th, we're going to have the CPI numbers out. So this is it's a bit of a double whammy and almost a triple whammy, quite frankly. I'm not too crazy about this trifecta. And what we're probably going to see is more fallout of the Silicon Valley Bank issue in a number of ways. So this week could see some major ups and downs. I think that what's probably going to happen, especially with smaller companies, is a flight to quality, or to companies that are earning profit, will likely become accelerated, since many of the companies associated with SIVB were venture-backed companies. Many of them were in the biotech space, in the technology area. A lot of them weren't making money, and if they don't have access to their capital, that's a real issue, and that's why the Russell 2000 got smacked as much as it did last week. So I think that there is this capital or cash access risk right now that is an underpinning relative to the Russell 2000 small cap stocks, but also NASDAQ companies as well, with unicorns and so forth. With a situation like this, you wonder, does it make sense to invest in financials at all? And I would say Most likely, no. Now, I think that the large companies, the big money center banks, are going to be okay, but some of these regional banks could be hit, and certainly there could be some stories as we've seen with respect to risk factors associated with these banks. But considering the market's year-to-date performances, uh, is all of this bad news in fact a future positive? It's a really good question, and I think that eventually it could be a bit of a positive because if all of the negatives are in the stock market and people are afraid to invest in equities or feel as if it's stepping in front of a falling knife, that could lead us a little bit closer to future gains. So let's look at the actual numbers themselves, huh? So this is a very ugly table, as you can see. But what's most important is this, and I don't think anyone's really grasped this because we're also focused on events rather than data. The peak to low levels on these indices is really quite striking. So essentially, we reached peak returns or peak levels on the major indices on February 2nd of this year, and the peak lows or the bottoms happened on Friday. So unfortunately, where are we now? We're in a correction phase on the Russell 2000 because it is a reduction of greater than 10% from the peak just 5 weeks ago. As you can see here, 7, 8, almost 10% on the Dow, the S&P 500, and Nasdaq. So we're going to be in correction territory here pretty soon. It looks like it could happen this week. But one thing I would mention, however, is the VIX, which has had a big has had a big increase already this year, and I think that it's still something that you should consider finding a way to play. And we've talked about VXX on a number of occasions, and I think that given the volatility, it's important more than ever. So, lastly, just a few words about the SIVB fallout and where we go from here specifically on this front. So, as I mentioned a moment ago, from the stock market side, regional banks are going to be hurt the most in the near term, and a number of those have already been cited and referenced out there. So if you own regional banks, probably now a good time to take profits, cut losses, what have you. I would not be looking to bottom fish there in any event. Also, any companies in the biotech space, perceived relationships with Silicon Valley Bank, tech companies, unicorns. These companies can be based anywhere. They don't have to be based in Silicon Valley. Now, one of the big issues here, of course, is not just the public companies, but on the private side as well, since Silicon Valley Bank did have a great deal of venture debt in its books that they loaned out. So we can see some really interesting transactions here going from Silicon Valley Bank to other entities. Now, just a quick moment on management stories. You're going to hear all kinds of stories, and we already are hearing a little bit of them now. You know, stock sales and all kinds of strategies and the like in the near term. But I want to mention two things. Why did this happen? This happened for two reasons. The first reason why this happened, quite frankly, is related to the business model that Silicon Valley Bank had, because they were not a traditional bank. They did not have your traditional loans. The business side, they did not have your traditional mortgage-backed securities, and so they went out and took money that they had as deposits and went out and bought mortgage-backed securities and also treasury securities. And at the end of the day, they were carried low interest rates, and of course, with the interest rates rising, that caused those values to drop dramatically. And the company was trying to cut its losses, raise some capital, because most of its customers are in the venture space or angel companies or very early stage and not making money, and they weren't raising as much money. They weren't completing many investment rounds, and also they had some issues perhaps with receivables, and so it was really a perfect storm that happened. So while the business model was great and the company was very well respected, because it was so different than most banks, those chickens have come home to roost. But also, quite frankly, why did it come home to roost? Well, it came home to roost because of policy, monetary policy, the economic policy of the current administration. Quite frankly, when you have interest rates go essentially from 1 to 5%, as we had on the 1-year Treasury bill, it's just indicative of how fast things have turned. And as a result, they paid the price, as are some of these regional banks as well. So it's important to note how important policy is and how it can have both a negative and a positive impact. So the question becomes now, will there be pressure as a result of all this in the federal government? Will there be a bailout? I suspect we're going to have some pressure. Whether or not it actually happens is another story, but I suspect that perhaps what may happen is because of the wide reaching effect here, maybe the FDIC $250,000 level is increased, and some stipends are offered by the feds, maybe some other banks, maybe some other entities. So there will be some stopgap here, but I don't expect a full-scale bailout. I do expect we're going to have some white knights. They'll be stepping in and taking care of former Silicon Valley customers, and also Silicon Valley Bank itself, perhaps buying the company as well. And what we're likely going to see over the next couple of months, especially when the next reporting period happens, now all these companies that are small, that are venture stage and so forth, they're going to have new disclosures. And what are these disclosures going to be? Did you have any relationship with Silicon Valley Bank? And if you did, how did that affect things? So here's a new thing that we're going to have to figure out as it relates to valuation and operations as well. And as I mentioned earlier, when bad news is good news, right now, certainly most people are just feeling really, really low on stocks. That will probably continue. Perhaps we can get to a point where things can be so bleak, and I put that in quotes, that we have no choice but to invest in equities because of the issues on the debt side, as well as other related economic issues, but also valuation, of course, with equities. So there is that silver lining. Maybe it happens the end of the year. Maybe it happens before that. Not quite sure. We've always felt that the end of the year was going to be when things would go well. But I think that sooner rather than later, we'll be coming back to you with some real great values that have good upside as well. So with that in mind, thank you very much for your time today. We hope that you enjoyed everything that we had to say. And if you have any feelings or ideas about anything we talked about, please drop me an email. I welcome your thoughts. And remember that nothing we discussed today is a recommendation to buy or sell. They're all discussed for informational purposes only. So we hope you have a great rest of your week. Thanks again.